Most new investors make one ETF mistake that quietly destroys their returns. And the craziest part is that almost nobody realizes they're making it until it's too late. This mistake can cost you years of growth, thousands of dollars, and in some cases, even make you give up on investing completely because you think ETFs don't work. But they do work.
Hi there. Before we dive in, please take a moment to read the full disclaimer on the screen.
The problem isn't the ETF. The problem is something else. And by the end of this video, you'll not only understand exactly what this mistake is, but you'll also know how to completely avoid it so you can grow your money faster, safer, and smarter than 90% of new investors. Before we get into it, let me ask you a quick question. Have you ever bought an ETF just because someone on YouTube, TikTok, or Reddit said it was a good idea? Be honest and drop your answer in the comments. I'm really curious how many of you have done this. Now, let's get into the story. Most new investors think ETFs are simple. You just buy a few shares, sit back, and let your money grow. And in a way, that's true. ETFs are simple. But the simplicity actually hides a trap, one that pulls in almost every beginner without them realizing it. The biggest ETF mistake that 90% of new investors make is buying ETFs without understanding what's actually inside them. It sounds obvious, right? You'd think everyone knows what they're buying, but they don't. Most people don't look inside the ETF. They don't check what companies it holds. They don't look at the top 10 positions. They don't understand the strategy. They don't check the expense ratio. They don't even know if it's passive or active. They just see the ticker symbol, see a chart going up, and buy it. And this one mistake leads to a series of problems that snowball over time. Let me show you how. Let's say a new investor hears that an ETF is popular. Maybe it's trending on social media. Maybe someone said it returned 20% last year. They buy it. They feel good. They think they're doing the right thing. But they don't look inside. What they don't realize is that the ETF is actually made up of mostly risky companies. Or maybe it's highly concentrated in just one sector, like tech or energy. Or maybe it's leveraged. Or maybe it's actively managed with high fees. Or maybe it doesn't even match their goals, like someone wanting long-term stability ending up in a highly volatile ETF without knowing it. Then the ETF drops. Hard. And because they didn't understand what they bought in the first place, they panic. They sell at a loss. They get discouraged. They lose trust in investing. They jump into another ETF they don't understand. And the cycle repeats. Here's the painful truth. Most investing mistakes come from buying things we don't truly understand. Let me ask you something. If you opened your ETF and looked at all the companies inside it, would you actually know what you're invested in? Would you be able to explain it to a 10-year-old? Be honest and put your answer in the comments. I want to know how many people truly understand their ETFs. The reality is that ETFs look simple, but they're only simple when you take a moment to understand what's inside them. And the craziest part is that doing this takes less than 2 minutes. You can literally type the ETF name into Google, scroll down, and see the entire list of companies. But most new investors don't do it. They choose ETFs by popularity, hype, or gut feeling, which is basically the worst way to invest. Now let's break down why this mistake is so damaging. Reason number 1, concentration risk. Many ETFs are marketed as diversified, but when you look inside, you find that 30%, sometimes even 40% of the ETF is made up of just a few big companies. If those companies fall, your ETF falls. But you wouldn't know that unless you checked. Reason number 2, hidden fees. Some ETFs charge very high expense ratios, especially niche ETFs like thematic funds or actively managed funds. A difference of just 0.5% in fees can cost you tens of thousands of dollars over a lifetime. But new investors rarely check the fee before buying. Reason number 3, misunderstanding the strategy. Some ETFs follow simple index rules. Others follow complex strategies that only make sense for advanced investors. Some rebalance monthly. Some hold risky assets. Some include derivatives, and most beginners don't read the strategy, they just buy the ticker symbol. Reason number 4. Wrong time horizon. Veterans know some ETFs are for long-term investing, while others are short-term trading tools. But beginners treat all ETFs the same. They get confused when a specialty ETF moves wildly up and down because they didn't realize it wasn't made for long-term holding. Reason number 5. Emotional decisions. When you don't understand what you bought, every dip feels terrifying. But when you do understand your investment, dips feel normal because you know what you own. Let me ask you a question right here. If the ETF you currently hold dropped by 15% tomorrow, would you know exactly whether to hold, buy more, or sell? Or would you panic? Tell me your honest answer in the comments. Your reply might help other investors who feel the same way. Now here's where things get even more interesting. Many beginners believe that buying multiple ETFs gives them more diversification. But here's the twist. If you don't look inside your ETFs, you might be buying the same companies over and over again without realizing it. For example, someone buys 3 different ETFs because they think they're diversifying. But when you look inside, you see all 3 ETFs hold Apple, Microsoft, Amazon, Nvidia, and Meta. So instead of spreading their risk, they've doubled or even tripled the same exposure. And they don't know it. This happens all the time. It's like thinking you ordered 3 different meals, but when they arrive, you realize they all contain the same ingredients. If Apple sneezes, your whole portfolio catches a cold. This is why understanding what's inside your ETF matters. Now here's something I want you to do later today. Take the ETFs you own, look up the top 10 holdings, and see if you're actually diversified. When you do this, you might be shocked. And if you learn something surprising, share it in the comments. Someone else might learn from your experience. Now, before I continue, if you're getting value from this video, make sure you like, subscribe, and share it with someone who needs to hear this. It helps the channel grow and helps more people avoid the mistakes we're talking about today. Let's go deeper. Another reason this mistake is so dangerous is because it creates false confidence. When you don't understand what you own, your confidence is based on luck, not knowledge. And the moment the market turns against you, that confidence disappears. But when you know what you own, when you understand why you bought it, and when you've checked what's inside, your confidence becomes real. You're no longer guessing. You're making informed decisions. Let's talk about something else beginners miss. Market overlap. This is where people think they're buying different ETFs that cover different markets. But in reality, those ETFs still hold many of the same companies. It's extremely common. Someone might buy a tech ETF, a growth ETF, an innovation ETF, and a NASDAQ ETF. But when you look inside each one, they're basically made up of the same big tech companies. So instead of diversifying, they've actually concentrated their portfolio even more. Now I want to ask you another question. How many ETFs do you own, and do you know whether they overlap? Put your answer in the comments so we can discuss it together. This brings me to one of the most important things I want you to take away from this video. Every ETF has a purpose. Some are designed for broad market exposure, some for income, some for specific sectors, some for dividends, some for aggressive growth, some for stability, some for trading, some for long-term holding, and some exist simply because companies want to sell something trendy. You don't have to be an expert, but you do have to know what the ETF is designed to do. If you don't know the purpose of the ETF you're buying, you're not investing, you're gambling. Let me share a quick example of how powerful understanding can be. 2 investors buy the same ETF. One understands what's inside, the other doesn't. When the ETF drops during a market correction, the first investor stays calm because they know the ETF holds strong companies that will recover. They even buy more at a discount. The second investor panics, sells at a loss, and later regrets it. Both people had the same ETF. The difference wasn't the ETF, the difference was knowledge. And this is why I say the biggest ETF mistake 90% of new investors make is not understanding what's inside the ETF they're buying. It leads to confusion, bad decisions, and unnecessary losses. But the good news is this: it's one of the easiest mistakes to fix. All you have to do is spend 2 minutes looking inside the ETF before you buy it. Check the top holdings. Check the expense ratio. Check whether it's diversified. Check the strategy. Check if it matches your goals. In fact, let me give you one more question to think about. What is your investment goal right now? Growth, income, stability, or diversification? And does your ETF match that goal? Drop your answer in the comments. Let's see how many people have ETFs aligned with their goals. Now, before we wrap up, I want to leave you with a powerful thought. Investing isn't about picking the hottest ETF. It's about building a strategy that fits you, your goals, your timeline, your risk tolerance, your future. And that starts with understanding what you own. Once you avoid the mistake of blindly buying ETFs, you'll already be ahead of most beginners. You'll make better decisions. You'll stay calm during market drops. You'll avoid unnecessary losses. You'll sleep better at night. And you'll grow your money with confidence. If you learned something valuable today, make sure you hit the like button, subscribe to the channel, and share this video with someone who's just starting their investment journey. It might save them from making the same mistake. And finally, tell me in the comments, what's the one ETF you're holding right now that you want to understand better? I'll read every comment and reply with insights that can help you avoid mistakes and invest smarter. Thanks for watching, and I hope this video helps you become a better, more confident investor.